In our today's video we are going to learn everything about hedge funds. So let's go. Hedge funds are alternative investment vehicles that pool capital from investors and employ various investment strategies with the goal of generating high returns. They are typically available only to accredited investors, such as high net worth individuals and institutional investors, due to their complex nature and potential risks. Here's an overview of key aspects related to hedge funds. 1. Structure and regulation. Legal structure. Hedge funds are typically structured as private investment partnerships or limited liability companies, LLCs. Regulation. In many jurisdictions, hedge funds are subject to less regulatory oversight compared to traditional investment vehicles like mutual funds. However, specific regulations vary depending on the country and can include registration requirements, reporting obligations, and investor accreditation criteria. 2. Investment strategies. Diversification. Hedge funds often employ diversified investment strategies, which can include long and short positions across various asset classes such as equities, bonds, currencies, commodities, and derivatives. Hedging. Hedge funds aim to mitigate risk by employing hedging techniques, such as using derivatives or short selling, to protect against market downturns. Active management. Hedge fund managers actively make investment decisions and may engage in frequent trading to exploit market inefficiencies and generate profits. Alternative investments. Hedge funds may invest in non-traditional or alternative assets like private equity, real estate, distressed debt, and venture capital, among others. 3. Performance and fees. Performance. Hedge funds aim to deliver above-average returns, often targeting absolute returns rather than benchmark relative returns. However, the performance of hedge funds can vary significantly based on the investment strategy, market conditions, and the skill of the fund manager. Fee structure. Hedge funds typically have a two-tier fee structure. Management fee, an annual percentage of assets under management, AUM, paid to the fund manager, usually around 1 to 2%. Performance fee, a share of the profits earned by the fund, often around 20%, but this can vary depending on the fund's structure. 4. Investor requirements and risks. Accredited investors. Hedge funds generally require investors to meet specific criteria, such as having a high net worth or substantial investment experience, to qualify as accredited investors. Lack of liquidity. Hedge funds often have restrictions on withdrawing investments, known as lock-up periods, which can limit investors' access to their funds for a specific period, e.g., 1 year or more. Potential risks. Hedge funds carry various risks, including market risk, leverage risk, concentration risk, and the potential for poor performance. Additionally, due to their complex strategies and limited transparency, investors may face challenges in assessing and understanding the fund's underlying investments. 5. Hedge fund indices and benchmarks. Hedge fund indices. Several organizations compile hedge fund indices to track the performance of the hedge fund industry as a whole or specific segments within it. These indices provide a reference point for evaluating hedge fund performance. Benchmarks. Hedge funds often compare their performance to relevant benchmarks, such as equity indices or fixed income indices, to assess their relative performance and measure their added value. It's important to note that investing in hedge funds involves substantial risk, and investors should conduct thorough due diligence, consider their risk tolerance, and consult with financial professionals before making investment decisions.